Hello everyone and good evening. I'm absolutely delighted to welcome you all to the London School of Economics and Political Science for this very special event that marks the launch of the Transition Pathway Initiative Global Climate Transition Centre, or for short, the TPI Global Climate Transition Centre. My name is Susana Morato. I'm the Pro-Director for Research here at LSE, and I'm also a Professor of Environmental Economics. So the centre that we're launching today and the types of issues that it addresses are very close to my heart and my own areas of interest. TPI was created in 2017 as a joint initiative of the national investing bodies of the Church of England and the Environment Agency Pension Fund, chaired by the Church of England Pensions Board. The initiative is a global effort led by asset owners and supported by asset managers. It has an important mission, which is to assess the progress of large corporations on their transition to a low-carbon economy, supporting efforts by investors to address climate change. The TPI Research Centre that we're formally launching today was established in June the 1st this year at the Grantham Research Institute on Climate Change and the Environment here at LSE. The Grantham Research Institute has been the academic partner of TPI since its inception in January 2017, when it launched the research program to assess the world's biggest companies on the transition to a low-carbon economy. Professor Simon Dietz, one of the speakers this evening, leads a group of LSE colleagues that produced a comprehensive, rigorous, and impartial analysis and data that goes into the Transition Pathway Initiative, analyzing whether companies' practices are aligned with the goal of limiting global warming to 1.5 degrees Celsius. TPI data is then used by investors in several ways, including to decide which firms to invest in. The research conducted at TPI here at LSE has already been hugely impactful and was deemed in a recent national assessment of research excellence in UK universities called the REF. It's deemed to provide outstanding impact in terms of its reach and significance, and that's even before the centre being created. Now with the centre, we're scaling up all this exciting research program. And LSE is very proud to host the new centre, which fully aligns with our core mission to produce social science research for the betterment of society. It also aligns with LSE's 2030 strategy, where we aim to deepen and broaden our real-world impact, convening influential people across different sectors to tackle complex issues. Now, none of this would be possible without the generosity and the support of our funders and our partners. And I would like to take a moment now to acknowledge the vital role played by the new TPI Centre's funders and partners. And they are TPI Limited, a non-for-profit company listed in the UK that was established with the mission to advance the TPI agenda. TPI Limited was instrumental in the creation of the Transition Pathway Initiative Centre. It is the Centre's key strategic partner. And you will hear more from the chair of the TPI board, Adam Matthews, later today. Actually, shortly, just after me. The FTSE Russell is the TPI Centre's data partner, co-producing data. It is also the TPI Centre's partner in commercializing the data. With the Church of England Pensions Board, FTSE Russell has created the FTSE TPI Climate Transition Index, which embeds FTSE Russell data with LSE's data and methodologies. We are delighted this evening to be joined by Jaakko Kuroshi, who is Global Head of Sustainable Investment Research at FTSE Russell. And then there is Climate Arc, which is a project housed at the Rockefeller Philanthropy Advisors, with initial funds from the Children Investment Fund Foundation, and they are a major funder of the TPI Centre. In addition to very generously funding the Centre, they bring extensive expertise in finance, business, and the climate worlds. And finally, the London Stock Exchange Group Foundation is also contributing generous funding to the TPI Centre, which aligns with their aims of accelerating sustainable finance and developing global sustainable standards. The London Stock Exchange Group Foundation is the philanthropic arm of the Global Stock Exchange Group, of the London Stock Exchange Group. So we're very grateful for the generosity and support of our partners who have enabled us to establish the TPI Global Climate Transition Centre and its transformational work. I look forward to seeing the centre growing and celebrating its successes in the years to come. Thank you very much.
Thank you very much, Professor Morato, and thank you, the London School of Economics, for hosting us today, both in hosting the event and more particularly being willing to host the TPI Global Climate Transition Centre and being willing to continue to work with investors. I'm here as the chair of the TPI and the asset owner founders of this initiative that today itself is formally transitioned into a dedicated global centre at the world leading LSE Grantham Research Institute. But I want to tell you why we set TPI up. As an asset owner, I remember sitting in an investor meeting with a certain energy company, being presented with an inch-thick publication that explained why they were leading the world in addressing climate change. Glossy graphs were being produced, and the chief economist trundled out to assure us that they knew what they were doing and we didn't need to worry, our investments were safe. I knew I was being sold something, but I wasn't clear how I could really understand and assess the company claims to determine if we could retain our investment confidence in the company or whether we should continue to vote for the board, directors and the chair. Everything was presented on the terms of the company. They were determining what was important and what was not. As with many colleagues here tonight that have joined us, I was being swamped with similar such outpourings of corporate sustainability reports and approaches to climate change from many companies. And as an asset owner, we occupy quite a distinct position in the financial system, and we needed to turn the tables. We needed a way to understand, on our terms, what was important to our decision-making to enable a meaningful interaction with the companies we owned. It's important to put this into context. As a pension fund, along with the many funds present in the room, we serve many millions of people around the world, and they're represented by the vast majority of the $50 trillion of assets under management that are actively already using TPI data. And at the back of this, we have a fundamental duty to serve our members' needs to provide them with a pension into the coming decades, and to do so in a manner that does not destroy the world in which those same people, in receipt of those pensions, will retire. This therefore requires us to understand the risks that threaten our ability to meet this, some would say, sacred bond with our members or beneficiaries. And climate change is unquestionably one of those major risks we need to understand and engage with. Some see it as a financial risk, others also as an ethical risk. Either way, we need to understand what the climate transition means for our investments, be they in individual companies, across high carbon sectors such as autos, steel, oil and gas or banking, or the implications of our investments in sovereign bonds. So faced with that deluge of information and a clear and present risk, together with the responsibility that we hold, we came together in 2016 to work out how we could create a tool that would decipher the transition. We knew as a pension fund we could not do this by ourselves. So we began talking to other like-minded and some would say forward-thinking funds. First amongst these were the Environment Agency Pension Fund, and in particular Faith Ward, who you hear from later this evening, and Emma Howard-Boyd joined us in forming a partnership. Together we began speaking to others, David Russell at USS, which is the university's pension fund, and colleagues at Westpath, Railpen, local authority funds, and then the Swedish National Pension Funds. We all had the same challenge. We needed a tool that could cut through the bullshit. So we agreed on some core elements of what that tool should look like. The first was public disclosure. If the information was material to the understanding of the company, then it should be disclosed to its owners so that it could be independently assessed. This would reinforce meaningful discourse that asset owners needed, and the reams of inch-long documents that were being presented with us could be challenged. The second was independence and academic rigour. We wanted to be guided by the best academic insight and instill independent analysis at the heart of TPI. Too many others had complicated agendas that got in the way of their analysis, and we needed the discipline of academia. I should note that for academics in the room, that far too few investors approach institutions such as LSE to find solutions. The third was we wanted it to be free. We wanted something that could be accessed by the whole market. No paywall, no privileged information that would be a barrier to smaller funds. Ensuring equity of access wasn't just an act of solidarity with smaller funds, but also part of building a collective understanding of what the transition meant. The more that can see the path ahead in a similar light, then that in turn would support the transition. The fourth principle was to ensure that it was accessible, transparent and intuitive. The transition is complex enough, and we were being presented with ever more complicated black box methodologies and arbitrary weightings that added complexity upon complexity. This didn't mean we wanted to hide from complexity, but ensure that the methodologies we were going to use were transparent, open to scrutiny, accessible and understandable, and that ultimately they led to the creation of a practical tool that could visualize the results. The last, and I would say particularly important, was that this needed to be asset owner led as an initiative. Not in terms of impeding the academic independence of an institution like LSE, but that it needed to bring the project to life. The only way that we were going to bring the project to life was if asset owners stood with it and really drove it and remained committed to driving it forward as a group, as we have done over the past years. But to convert intent into actual output required us to build it. And as with most things challenging, we called upon the wisdom of Dr. Rory Sullivan of Kronos Sustainability, who's with us tonight, who's the Chief Technical Advisor of TPI. His job was to shepherd us and to ensure we got to our destination. The next step, though, was to convince the Grantham Research Institute, where we met the indomitable Professor Simon Dietz, the then director of the Institute. It's fair to say, Simon, and I think you'll completely agree, that from that moment your life was forever better and changed. And we tweaked your intellectual curiosity. Your low-carbon energy thrusters were put into... Who wrote this? No, I wrote it. Your low-carbon energy thrusters were put into action as to how he could demystify the transition for this group of needy and demanding investors, and to do so in a way that would actually inform the decisions that we make about the way that we invest. However, the last ingredients of this transition pudding we're baking, was the ingredients of data. So we tendered for a data provider. But the answer back we received from FTSE Russell was not a tender response, but a suggested partnership, an openness to sharing the data that they gathered for the good of the initiative. The partnership that was proposed back then is one that has been built upon and brought us here today, and for that we're extremely grateful, and Jaco, who's a key part of TPI, will be speaking later. I should note, as with all such undertakings, there are many names that should be mentioned, trustee boards that are willing to stand behind the initiative and stand behind at key moments when it seems a little bit risky. It's hard to list them all, but I do want to pay tribute to those that have served on the steering committee, to those that are continuing to serve on the board of TPI Limited, especially Marion Maloney from the Environment Agency, and those on the International Advisory Board, and also especially to Joanne Lewis, our dedicated secretariat. I also recognise the investor networks that coordinate many of the investor activities on climate change around the world, in particular PRI, but also IIGCC, CERES, IGCC, AIGCC. If you want to work in finance, there's many, many letters. Those fund managers that were willing to back this initiative also were critical, and we're very grateful to those that became research funding partners. But the beating heart at the centre of TPI has been the brilliant minds of those that have worked with Simon Dietz. In particular, I note the tireless contribution of Beata Biankowska. I'm not sure if she made it this evening. I know she's had a baby recently, but I think you've had to take her email account off her. But she's done amazing work under the leadership of Simon. But the rest of the team has been simply incredible. From developing understandable methodologies to conducting analysis through the maintaining of the independence and the rigor of the feedback process, the confidence we have in TPI is confidence built upon the shoulders of the work of this group of people and their dedication to the TPI mission. And if you don't mind, I know there's a number of you here, not all of you, but do you mind standing up? This is the worst bit. It's like being back at school, this, isn't it? But there are a lot of researchers that contributed. Thank you. That group's going to expand as the mission of this organisation, this centre, increases, but thank you very much, and to all those that aren't with us this evening. But I also want to acknowledge Faith Ward, who started as co-chair with me, at the time the Environment Agency and later of Brunel. Those formative years required us to have two jobs, TPI and our day job. I know this was the highlight of her career and a key experience in her personal development working with me, but seriously, TPI was built on a yin and yang partnership that has meant that we could do what we set out to do. Faith can confirm what a joy it was. As you will see from the results tonight that Simon will present, what we set out to do back in 2016 and launched in 2017 is starting to be delivered. Back in 2017, we couldn't measure the vast majority of companies TPI assessed, and we took a plunge to create a tool that could do that. Since then, there's been a disclosure revolution, and while some companies are still outposts of resistance, TPI can now cast a searchlight into the transition plans of so many more companies and sectors. There is no clearer way to see this than in our partnership with Climate Action 100, the 600-strong investor initiative engaging the world's 167 most carbon-intensive companies. TPI provides the backbone of the CA100 net zero company benchmark for those companies' assessments. If engagement with these companies is to work, then it will do so informed by this benchmark and the analysis of TPI. We were also challenged that it wasn't possible to embed forward-looking TPI data into passive indexes. For those of you that know what passive indexes are, I suspect it's high proportion, they're terribly good fun. And today, through the construction of the FTSE TPI Climate Transition Index, TPI now provides data feeds that directly inform multiple billions invested in these indices. They weight investments in companies according to the assessment from TPI, and a quarter of our pension fund, the Church of England Pensions Board, is invested in line with this approach. Whilst it's billions at the moment, I'm under no doubt this will be trillions in due course. But new areas of work emerge as TPI supports the work of IGCC to develop a net zero standard in sectors such as oil and gas and mining, where we need to go further and deeper in understanding what the transition means. Also, the work that Claire Richards has led in developing a global responsible lobbying standard ensures that we can find a way to hold companies accountable for delivering on their commitments to be net zero and how they influence public policy that shapes their ability to deliver on targets. This initiative today grows into a dedicated centre that's been made possible by the work that's gone before it. As we enter this new exciting phase, we'll rapidly scale, broaden, deepen the analysis of TPI. This is research led by a world-leading team with real-world impact and applications serving the interests of many millions of people that have pensions. Finance cannot manage the transition by itself. It is a partnership with many, and in particular with governments, but tools like TPI mean investors are able to play their part to drive the change that is needed in line with the goals of the Paris Agreement, and to ensure that pensions can be paid and the world our beneficiaries retire into is not destroyed by the way that we invest. So Simon, the LSE team, it is over to you. You have our considerable support and determination, and the TPI Centre is at the heart of a global accountability infrastructure supporting the transition. Thank you and good luck.
Thank you, Adam. And good evening, everyone. Let me just briefly begin by extending my own thanks to the TPI supporters, TPI Limited, Climate Arc, FTSE Russell, the London Stock Exchange Group Foundation, and also my many LSE colleagues who've helped me get it this far. But enough of thanks. Let's do some charts. TPI covers many sectors, from coal miners through steel makers to banks. But what I want to talk about tonight are energy companies. That's really for two reasons. The first is that the energy sector, broadly construed, is, I think most people would agree, the most important sector from the point of view of making the transition to a low carbon economy. And secondly, we just finished an analysis of the energy sector, so I can show you some new data. Now, I know that many of you are familiar with TPI's approach and TPI's data, but I also know that many of you are new to it, probably haven't seen our research before. So I just wanted to take a few minutes, first of all, to tell you about some of the fundamentals of our approach. Our mission is to provide open data on the progress companies are making on the low carbon transition. And broadly speaking, when we do that, we follow four principles. The first is that our approach is disclosure based. So company assessments are based only on publicly available information. And that confers many benefits. One of the most obvious is transparency. It's clear where we got the data, and it should be clear what kind of transformations we made to the data in order to obtain our results. But apart from that, if you want to understand what companies are doing on climate change, then most of the time company disclosures themselves are the only source of data we've got. There are exceptions to that. There are some interesting uses of satellite imaging. Some regulatory bodies around the world hold some interesting information about companies, for example, the performance of car makers' new fleets, or the emissions of installations regulated by the EU emissions trading system. But these are more the exception. For the most part, if we want to know what a company is doing on climate change, then we depend on the company to tell us. Second principle is that our data should be accessible and easy to use. The primary purpose of TPI at LSE has not been to produce articles to be published in scholarly journals. We do that, but that is not our principal aim. Our principal aim is to produce research that actually produces change in the real world and helps investors manage the issue of climate change and the transition. Thirdly, when we started, we didn't want to come in there and present companies with yet another framework through which to disclose information. So we provide an independent assessment framework, but we work with the grain of existing disclosure frameworks like CDP, formerly the Carbon Disclosure Project, and TCFD, the Task Force for Climate-Related Financial Disclosures. And lastly, because the original application of TPI was listed equity, our fundamental unit of assessment to this point has been the whole corporate. So you can contrast that with, for example, green bonds, where the interest of the research is in particular projects that companies are doing. Our interest has been in the whole corporation. So how do we apply these design principles? Well, our data comes in two forms. We basically look at the company climate process from two sides. The first one we call management quality, and this is an assessment of the steps that companies have taken to manage and govern their carbon emissions and low carbon business risks and opportunities. You can think about this as an input measure, a measure of the amount of effort that companies are making on climate change in terms of managerial attention and management and governance practices. On the other hand, what ultimately matters for the climate is emissions. And that's the aim of our carbon performance assessment framework. We ask the question, how much do companies emit, and do their emissions pathways align with international climate goals? Now, what do these two assessment frameworks look like? Well, we judge management quality based on a set of currently 19 indicators, each of which you can understand as a management practice. So at the bottom of the staircase you can see here include very basic steps that a company could take to manage climate change, such as admitting that climate change is an issue for it, what I sometimes like to call its Alcoholics Anonymous moment. From that point, you might ask a company to formulate and disclose their policy on climate change, to set some kind of emissions targets, to disclose to the markets what their carbon footprint is, what they're starting with their own operational emissions, but later trying to take in perhaps their value chain emissions, both from upstream suppliers and downstream consumers of its products, through to more sophisticated management practices like aligning executive pay with climate-related key performance indicators, introducing an internal carbon price that the company uses for capital budgeting, and so on and so forth. These data are fundamentally provided by our data partner, FTSE Russell, and we work with them and translate them into this framework. It's also an approach which we've seen before at LSE. I think it's very similar to the groundbreaking work that Nick Bloom and my LSE colleague John van Reenen have done in economics to understand what explains big differences in productivity between firms. So Bloom and van Reenen's work hypothesized that big differences in productivity between firms could be explained by how well managed firms are. But working out how well managed firms are is a difficult thing, and therefore they came up with the idea of rolling out a big survey, asking companies, well, how do you manage yourselves? What kind of practices do you implement, and what things do you not do? Without wishing to implicate Nick and John with any of this, I think there's a clear analogy with what we're doing here. On to carbon performance. So how do we assess whether a company is aligned with international climate goals? We do this based on the so-called sectoral decarbonisation approach, which was not our invention, though we immediately saw that it was a very good way to do this in our judgment. How does the SDA work? Well, you start with a global carbon budget that is consistent with an international climate goal. So, for example, we know from climate science that if we want to limit global temperature increases to 1.5 degrees above the pre-industrial level, that gives us a CO2 budget. We then divide that budget between sectors using some kind of integrated economy energy model, such as that of the International Energy Agency, the IEA. And the reason for making this step is because the challenges facing companies in making a transition to a low-carbon economy very much depend in what sector they're in. The challenge facing a diversified mining company is very different to the challenge facing an oil and gas company. It's very different to the challenge facing a steel maker. It's very different to the challenge facing a car maker, and so on. Thirdly, we divide emissions by sectoral activity from the same scenario to generate a so-called intensity benchmark. In other words, emissions divided by economic activity. You can think of this as a normalization step. You have to do this in order to be able to compare companies at a given point in time. Otherwise, when you stack up one company against another, all you really find out is how much bigger one company is compared to another. But this normalization does create hazards, because as I'm sure many of you know, the difficulty with intensity approaches is that it is possible for a company to reduce its emissions intensity while its absolute emissions actually increase. Now, the point of the sectoral decarbonisation, this problem cannot be made to disappear entirely. But the point of the sectoral decarbonisation approach is at least to constrain the benchmarks with a global carbon budget to start with. So that's the benchmark side of things, which gives you the blue shaded areas on the chart to the right. Now for the company side of things. We first calculate companies' emissions intensity using their public disclosures. The team downloads annual reports, sustainability reports, tedious spreadsheets, obscure details of company websites, and uses all of that to work out how much a company emits. We then project a company's future emissions intensity based on any emissions targets they've set. So our future projections, in effect, answer the question, suppose a company meets its targets, where will it be? And then lastly, we compare the companies with the benchmarks. And hopefully that's all quite intuitive by now. You can see how it would look on the right-hand side for a real but anonymized oil and gas company. So now let me show you some results, starting with management quality. So we recently assessed 191 of the world's largest publicly listed energy companies across 4 sectors: electricity utilities, oil and gas producers, oil and gas distribution companies, and coal miners. Coal mining being a mixture of diversified mining companies with a coal business and specialist or pure play coal mining companies. We found that only 1% of companies are on our management quality level 0, meaning that only 1% of companies, or 2 companies, are, on the basis of their public disclosures, apparently unaware of or not acknowledging climate change as an issue. 9% of companies are on level 1, meaning that they demonstrate at least they've had their Alcoholics Anonymous moment. 14% of companies are on level 2, 41% of companies are on level 3, and 35% of companies are on level 4. Now, if we take the levels of the staircase here and turn it into a continuous variable, yes, I am an economics professor, I have to do something like that, then we can say that the average company out of these 191 has just exactly stepped on to level 3. I'll say more in a few minutes about what that concretely means. For now, let me just disaggregate this into the different energy subsectors. And you can see that average scores range from 3.4 for oil and gas producers, through 3 for electricity utilities, 2.8 for oil and gas distribution companies, and 2.3 for coal mining companies. What about carbon performance? So first thing to note here is that for technical reasons which I won't go into, the number of companies that are possible to assess on carbon performance is smaller than the number of companies that is possible to assess on management quality. We've got 132 companies here in 3 sectors: 74 electricity utilities, 52 oil and gas producers, and the 6 big global diversified mining companies with a coal business, for example, BHP, Anglo American, Glencore. And we're looking at the alignment of this set of 132 companies with international climate goals, and we're doing it on 3 time slices. 2025, which we could think about as the short term, 2035, which we could think about as the medium term, and 2050, which we can think about as the long term. And so you can see that in the short term, 63% of companies are not aligned with any of the international climate goals that we consider. 10% would be aligned with countries' national pledges, their nationally determined contributions to the Paris process. 2% would be aligned with below 2 degrees, and 23% would be aligned with 1.5 degrees. In 2035, 46% of companies are not aligned, 28% are aligned with the national pledges, 10% with below 2 degrees, and 14% with 1.5 degrees. And in 2050, which is the point at which global CO2 emissions need to be approximately at net zero, 38% of companies would be not aligned on the basis of their targets, 9% would be aligned with the national pledges, 32% with below 2 degrees, and 19% with 1.5 degrees. Disaggregating this by sector, we can first see how difficult the transition is in the oil and gas sector. The oil and gas sector is one of the sectors that we look at that has the lowest degree of alignment with international climate goals. And you can see that quite clearly on any time frame here. But it is encouraging to see that by 2050, no less than 7 of these big global oil and gas companies would actually be aligned with 1.5 degrees on the basis of their targets. Things look more encouraging in electricity and diversified mining. There's a story to tell there about why that is. It has roots in technologies, business models, regulatory pressures, and to some extent also in geography. But what you can see is a larger share of companies aligned with international climate goals in these 2 sectors on any horizon. Now, although this is the official launch of the TPI Centre, we've been assessing companies for a number of years now. And that enables us to actually assess progress. So here I'm showing you 4 years of TPI data. both on management quality and carbon performance. Now, if you're being pedantic, and as an environmental economics professor, in general, I am all in favour of pedantry. If you're being pedantic, you will see that the sample is changing over time. Right? The number of companies is mostly going up as new companies are added to the sample, and in some cases, companies are leaving the sample, for example, because they've been acquired by another business or because they've delisted themselves. But you'll just have to take my word for it here that the basic story I want to get across survives controlling for these issues, okay? So what we can see in essence is progress, but it's slow progress. The average management quality score of the 135 companies we assessed in 2019 was 2.6, and that's inched up every year to 3.0 this year. If we look at carbon performance, the numbers are harder to summarize in one sentence, but you can see the red slice of the pie shrinking and the yellow and green slices of the pie expanding, which is my highly technical way of telling you that alignment with international climate goals is improving, but progress is slow. So at this point, it's worth, in a sense, pausing and trying to interpret these data in words. Most companies have reached level 3 on management quality. This is good news, but this is a fairly low bar. Concretely, reaching level 3 means that a company has done a minimum of 4 things. It's recognized climate change as a business issue. It has a policy commitment to act on climate change. It has set some kind of emissions reduction target, and it has disclosed its operational emissions, or to use the language of the Greenhouse Gas Protocol, its Scope 1 and 2 emissions. These are really important steps, but there's a lot more that a model company would be doing on climate change. So we understand that this is a relatively low bar. As far as carbon performance is concerned, essentially what we see is the following. Net zero targets are proliferating, and other research has also shown that over the past few years. Arguably, a remarkable number of companies have now set some form of long-term, mid-century net zero goal, if not earlier. And this is also good news. But our analysis of carbon performance indicates that many big energy corporations, particularly in oil and gas, though also beyond, still don't have a genuine net zero target. The first issue is, of course, that many companies don't have a net zero target whatsoever. But the other issue, which I think that our research really helps to shine a spotlight on, compared with other approaches that just count the number of net zero pledges there are, is that it shows that some net zero pledges flatter to deceive, in the sense that principally companies define their net zero target as covering a very limited scope of their total carbon footprint or life cycle carbon emissions. This is most obvious in oil and gas, where companies pledge to reduce their operational emissions to net zero by 2050, but don't propose to do anything about the products they sell and the emissions that arise from them. There are legitimate debates to be had there about the degree of a company's responsibility, but I think that most people would agree it's not credible to evaluate an oil and gas company solely based on the emissions produced from extracting and refining the product. You also need to look at what it's selling. Another issue is that cynics might say it's easy to set a target, particularly a long-term target. So I think increasingly the research frontier in the kind of area that TPI operates is, there are different ways to put this, but I think one way to put it is to say, how can we measure the credibility of long-term targets in the sense that companies are actually serious about meeting them? Well, one thing we could do is we could look at the existence of short and medium-term targets that are consistent with companies' long-term goals. I think the theory of change here is that long-term targets are something like a bridgehead. And once the bridgehead is in place, it has implications for companies' trajectories in the more immediate future, working backwards or recursively. In addition, since temperature depends on cumulative CO2 emissions, short and medium-term targets also matter for the climate. Both of these things explain why short and medium-term targets are back in fashion. Why do I say back in fashion? Well, when TPI started in 2015-16, most targets were 2025 or 2030 targets. Very few companies had a 2050 target. Then net zero took over as a focal concept in climate policy, and I think some commentators thought that the answer to all our problems with corporate climate action was setting a mid-century net zero target. But having done that, we naturally realise that that only constrains companies' actions over the next few years to a limited extent. So we need to be interested again in their short and medium-term targets. With that in mind, broadly speaking, what we see today is that alignment is better in the long term than in the medium and the short term. And that should be a worry, both from the point of view of the credibility of corporate strategy on climate change, but also for the climate. Concretely, it implies that the cumulative carbon emissions of the 132 companies we assess here will exceed their share of the global carbon budget. Now, as some of you know, I am by no means a fan of the fair share concept, but I think that this result implies that if these companies are going to emit too much, that excess will have to be made up by a shortfall somewhere else. And we might think of that as being unlikely. The other way that we're now trying to shed light on this credibility question is through thinking about decarbonisation strategy and companies' capital alignment. Companies need to back up their targets with decarbonisation strategies and by decarbonising their capital expenditure. We started to analyse these issues through our work for the Climate Action 100+ initiative, which covers 73 of the large companies that I've showed you data for so far. And again, these are data which have been produced in partnership with our colleagues at FTSE Russell. So what I'm showing you here are 4 new indicators, if you like, which look at various aspects of companies' decarbonisation strategy and their capital alignment. The top indicator asks whether a company has a decarbonisation strategy that explains how it intends to meet its long and medium-term targets. We find that 49% of these 73 companies disclose some detail about their decarbonisation strategy, but only 16% have so far quantified the key measures that they plan to take. The bottom 2 indicators ask to what extent the company is showing that it's decarbonising its capital spending. Indicator 6.1 asks a company to explicitly commit to aligning its capital expenditure with its long-term targets. And indicator 6.2 asks the company to provide information on the methodology it uses, key assumptions, key performance indicators, and key outcomes. And you can see here that the share of companies providing evidence on what decarbonisation means for their capital spending is currently very low. Okay, let me wrap up this talk just with a few remarks about the road ahead for TPI and for the TPI Centre. Our goals are to place transparency and independent analysis at the heart of investor decision making. We want to support global investor engagement initiatives. There are many of them. Those include Climate Action 100+. We want to support investors who want to align their portfolios with net zero targets, and we want to support the low carbon transition beyond listed equity. In other words, in sectors like banking, corporate debt, and sovereign debt. That implies lots of things that our team will be doing in the way of new research, including a capacity to respond to new company disclosure rapidly for key companies, the number of key companies yet to be determined. Relieved looking faces at the front. Further development of our banking framework, which we have now already in pilot format. New indicators to bridge the gap between governance and management on the one side and emissions on the other. I've given you a flavour of what they look like in the previous slide. Carbon performance methodologies for new sectors like chemicals and food producers, and new frameworks to assess other asset classes like sovereign bonds. And we have a project on the go at the moment developing a framework for that. So that is the end of my talk. I hope I haven't bored you too much. We now move on to the panel segment of the discussion, of the evening, and so I'd like to invite Adam Matthews, Jaakko Kuroshi, and Faith Ward up to the stage with me to have further discussion. Thank you.
Simon Dietz is probably saying.
So good evening, everybody. As Simon says, and thank you very much, Simon, for that excellent presentation. I think we're going to dig a little bit deeper into some of what you shared with us there. I've got some questions to ask my colleagues here on the panel, but this is very much an opportunity for you also to ask questions. You've got a fantastic opportunity to ask both myself and Adam as asset owners, Jaakko from sort of FTSE Russell about the data and the challenges there, and also Professor Dietz in terms of all the clever stuff that happens at the TPI initiative behind the scenes. Although he may need to draw on some of his colleagues in the front row from what I could tell there. But so please do think about the questions that you would very much like to ask. But I'm going to kick off a little bit, and I'm going to go to you first, Jaakko. One of the points I think that came across quite strongly, both from Simon's presentation about the purposes of TPI, and one of the sort of things that Adam outlined as one of the things which really needed was for it to be accessible and easy to use. And I think we've definitely got a tool that is that. It makes it look deceptively easy. It's like, get that data, stick it into there. That looks really simple. Do you want to give us a little bit of insights as to kind of perhaps what happens underneath and behind the scenes there as to how easy it is to actually get some of this data in this form through to the TPI Centre? So, Jaakko.
Yeah, thank you very much, and great to be here, and great to see so many familiar faces also in the audience. I think, as you said, it seems deceptively simple. You just go on the website and you download the spreadsheet, and it has the answers in there. And it's actually a very complex process to develop that data and to really manufacture that data. And in what we see is that it really goes through many hands. And I think that's one of the things that makes TPI so unique, that it starts with the disclosures of the companies. It's the assessments from the analysts that look at that data, make those assessments from all different angles with lots of different indicators. It then that happens on our end, but it also happens at the Grantham Institute. But then it goes further than that, right? It goes back to the companies that look at this data, and the one thing that I've always found fascinating about TPI is the huge response rates from the companies. How many companies are actually engaging with this data, looking at this data, and at what levels of seniority people are looking at it. I remember one particular instance where this was in a CA100 plus context, where a particular data point was contested by a very large company who we shall not name here, but our CEO got a 6-page letter from their CEO that was effectively concerned with a single data point. Trust me, that wasn't a fun exercise for us, but it just shows you how serious the companies are taking these data points, and they will come back with comments. They will provide additional data. They will, in many cases, if they don't like our answers, challenge us again. But it's also the investors that look at that data. It's the NGOs that are looking at this data. And so you have to deal with this huge amount of input from all these different sides. And you may ask yourself the question, why bother? And the answer to that is that I think when we're looking at something as complex and as fast moving as the global transition to a low carbon economy, it's essential that we create a shared understanding, a shared language that allows asset owners, NGOs, shareholders, companies like ours to look at a company and assess it through a shared set of norms, and to make that data also available to public scrutiny. And so that's, I think, kind of in many ways the secret sauce to this initiative, and why we've also invested heavily in supporting this initiative, because for us ultimately that shared and transparent data is absolutely critical when we build financial products of that, where often the question, oh well, is that not just greenwashing, is kind of the first thing that is being thrown at you. Oh, what data are you using to make those decisions? So I think, yeah, that's maybe would be my answer.
Yeah, I think there's an awful lot of hard work there behind the scenes. So maybe to Adam, I mean, has it delivered? I mean, what difference is it making to you on a sort of a practical level as an investor, and in these engagements with companies? Is it allowing you to cut through the bullshit?
Yeah, absolutely. And I mean, I think the charts that Simon showed clearly demonstrate that there's change happening. We're in the transition, we're tracking the transition, and increasingly we're moving to an accountability framework of whether that's genuinely aligned or not, and that therefore gives us an insight that we can use in our engagement with companies. So unquestionably it's sort of demystified. I mean, I mentioned the point that we couldn't measure the first couple of years. We were developing methodologies. We then had to apply those against companies. We grew the universe from 20 to begin with to where we are today, and we'll be into 10,000 odd. That's data from Hugh that's gone through. But I mean, I'm clear that we've set out a framework here in terms of what we expect from companies. They're clearly engaging with it. The point Jaco makes around CEO engagement with this is very true, and it underpins key engagements like Climate Action 100. But also, I mean, we as a pension fund have a net zero goal. We need to have tools like this that make it real for us in asset classes, in individual investments, and in other asset classes. And TPI for us is absolutely essential to we as a pension fund are able to deliver on our own net zero commitment and understand the complexities. But the one thing I will note is that we're all walking through this, developing an understanding, and we've got to be sort of able to evolve tools like this, evolve complexity and understanding, and equally deal with the fact that our knowledge of what good looks like is also evolving alongside it as well. And so that's quite a challenge to do, but I think that's part of the challenge of the transition.
I mean, reflecting myself, I think one of the ambitions was to really help that beneficiary communication, because it was very hard to demonstrate progress of engagement. We were being accused that how is engagement actually delivering any difference? And as you say, this gives us something much more tangible to share, and we've set targets around TPI in terms of moving companies up levels, the levels that we were targeting in terms of having a number of the highest proportion of our companies on level 4. So we've used it to set tangible targets, which we then can measure those, and I'm hoping that's how it's helped, and certainly the feedback we've had is in that beneficiary communication as well, and hope that accountability. Talking about that accountability, we've still got companies that are zero. Those companies at the sort of the bottom end tend to be those in emerging markets. Is it, should we just be giving up? Should we be divesting from these, Adam? I mean, that's the temptation.
I mean, I think I can understand the temptation, and to be clear, that many of the funds that are in the room are all under enormous individual commitments to deliver net zero and make that a reality. Equally scrutiny from be it their beneficiaries or other stakeholders in how they're actually going to meaningfully deliver that and be true to that commitment. And an easy default is, well, just sell out of those high carbon emitting assets. Now, when it's in an emerging market, I think this is one of the areas that we're sort of in discussion. How do we evolve a tool like TPI to pick up some of the complexity of the transition, for example, in a country like South Africa? It's a country that our fund knows well. We work a lot with the mining industry there. It's an energy system dependent on coal. There isn't an alternate renewables sector that hasn't been turned on. It's got to be built. It's being built, but it's got to still be built over some time. So therefore, you've got a reality of its existing energy demand, which is met by coal. You've also got the mining sector that is providing that coal in South Africa, 120,000 jobs. So how do you manage that transition? And I think that's where we've got to go for investor solutions that don't simply push for disinvesting those awkward companies, but actually acknowledging that, okay, those coal assets are going to transition over time. They're better assets run in a well-run company. And at the same time, we're going to understand the trajectory that the South African government has set for its transition, its development of its renewables capacity, and then at what point do we basically flip from that coal-based energy system to the new energy system that's based on renewables? There will be transitionary gas in there as well, and how do we understand that? And I think we're going to have to get to that level of complexity in emerging markets to prevent the kind of knee-jerk reaction of we'll just disinvest in those assets, because that isn't helping that country transition. And South Africa has set an ambitious national goal, and I think we have a responsibility to work with them as finance to find a way to provide the resources to enable them to achieve that goal, which means we've got to face some realities of how to engage with those difficult assets without just simply washing them out. Because washing them out doesn't actually remove emissions, it just transfers ownership. And that, in my mind, isn't actually an answer to the solution. So I think we've got to evolve our approaches as investors. TPI has got to help us understand that, and equally how we relate that to our own net zero goals as a pension fund. How do we treat those emerging market assets, the pathways that they're on, so that there's fairness here? Because some of the expectations are quite internationalised. Actually, there's a legitimate path for South Africa to follow that it's determining. We need to support that.
Thank you. It's definitely, how we bring that sort of, I think for the next phase, how we bring those sort of, not only across asset classes, but also, as you say, different regions, reflecting on sort of the different sort of headwinds in different environments. I mean, one of the challenges we've got is using the alignment, so using very much the carbon performance, which we find perhaps one of the most exciting components of the TPI package to evaluate if a company's not aligned, and by what timeline, when do we kind of step away perhaps? That's our pressure, is to kind of set some very time-bound targets as to when we might invest or not invest with a particular company. And what I find challenging at the moment is to know what, and Simon's, and I'll address this question to you, Simon. I looked at the data, we did our analysis, we had, well, they're aligned at 2025, but not 2050. So are they aligned? They're aligned, these companies are in 2050, but not 2025. And it was different companies in each of these different, I went round in circles, and I tried to explain this we had a workshop last week, and we were trying to explain this to the clients of the partnership. And they were a bit baffled. And I said, well, if my objective was to land just how complicated this question is, I think I've done it. Because they were utterly, and it is, what does alignment mean? So Simon, maybe if you could help an asset owner.
Well, I think that the heart of the matter here is that to my mind, there is no unambiguous scientific answer to the question, when does a company need to align? The reason for that is that companies start either side of the benchmarks. Some companies are much dirtier than the industry average. Some companies are much cleaner than the industry average. We know that by 2050, roughly speaking, they all need to be at net zero, but at what point do we ask companies to bring their emissions under the benchmark There is no unambiguous answer to that question unless you want to follow an approach which defines fair shares of the global carbon budget for individual companies. But my principled objection to that as an economist is that you absolutely want to allow the companies who find it easier to reduce emissions to do more, and the companies that find it hard to reduce emissions to do less. Otherwise, I think investors will be unwittingly completely undercutting all the good work that is done by things like the EU emissions trading scheme, because that is a fundamental principle that underpins it, that companies with lower costs should do more and companies with higher costs should do less. Unfortunately, that then leaves the question of what's the magic year for alignment. It leaves it up in the air.
What's the magic year?
Sometime between 2025 and 2050.
I mean, maybe back to you, Adam, and I'll open this then to the floor shortly. We talk about this fairness. How fair is it from a sort of to ask companies to be ahead, perhaps, of their policy headwinds? We've talked about the challenges in emerging markets, but these challenges aren't just about emerging markets. We've got, policy headwinds in other parts of the world. How reasonable is it to ask them to target 1.5 degrees when their policy backdrop isn't supportive in their own policymakers?
Yeah, I mean, look, I think it's really encouraging that you've got companies that are setting 1.5 degree targets, and some are starting to align over the 3 time periods that TPI assesses. So you've already got companies starting to do that. Now, there's a variety within that mix in this, but this is a key part of the transition, these 3 sectors that we're looking at. But let's not forget, society set the Paris Agreement, that the governments of the world came together to set the goals of the Paris Agreement, significantly below 2 degrees with the ambition of being 1.5. So there is a societal goal. Companies with pension funds are all part of that society, and I think expecting companies to share that goal, I think, is a perfectly legitimate thing. The question is, making the target and then detailing the dependencies, I think, is really important. So that's why, I mean, we're both on the Treasury Task Force looking at what transition plans look like and what a credible transition plan is for companies listed in the UK. I think that's the opportunity where you can indicate your commitment to those targets. I think you can, in that plan, detail how you're going to achieve them, but equally indicate those dependencies that you don't necessarily control, but you can influence. Some of those may be technology, but some of them are going to be public policy. And at the moment, you don't necessarily have public policy aligned in many jurisdictions to net zero. And I think underlining that dependency with public policy also is part of the way ensuring that public policy isn't off the hook of the job it still has to do to ensure alignment. Because this isn't a job just simply about what finance and companies can do. It's about what government needs to do, and that pressure still needs to be maintained. But companies are huge influencers of government policy, and that's part of the reason we've also evolved in TPI, working with IIGCC, Claire Richards at the back, and Richard also from LSE, is a way to understand what meaningful, good, responsible corporate climate lobbying is, because that influence has to be exerted in line with those company commitments. And still you have companies that are funding industry associations that are lobbying completely at odds and unaligned to the strategy of the company, which is to be net zero aligned. And that, for me, is a contradiction that we need to address as investors. And I think ensuring that those dependencies are drawn out in the transition plans is the opportunity to show where that pressure needs to be exerted. But I don't think that means you don't then set a net zero target as a company, but I think you have to give some qualification within it. And I think it's right for us to expect it.
No, absolutely. And I think we've found there's been use cases. I mean, obviously, you talked about kind of the mission and vision of TPI when we started, particularly that asset owner, trying to empower and equip them to be able to kind of to engage, but also with their asset managers, and asset managers have used it extensively. But actually, the use cases have gone beyond that, and it has been actually used by policymakers to evaluate kind of where the state of transition is. And in fact, our state of transition report sort of really brings that to the fore. And talking about transition plans, because Jackie, you're also on that group. How are you seeing sort of TPI flowing into? How do you see that connectivity between this and that work that's happening to have mandatory transition plans within the UK and then more broadly on a voluntary basis globally?
I'm going to come on that transition plan point in 1 second. I just wanted to pick up on one piece that Adam said. I think we also need to be conscious that the transition introduces huge amounts of financial risk in sectors that have to transition. And we know that not all companies are going to make it. We don't know whether we're going to make it to 1.5 degrees, but we do know that for a business model of an oil and gas company as it looks today, there's not going to be a space for that in 2050 in a society. So there is a real question around the kind of credibility of those transition plans. And I think if you talk to companies, if what you have done for the last 300 years is coal mining, to ask them to kind of completely reinvent that business model, that is a really tough ask. And there is really companies out there that are really committed to this, that are year after year thinking about, okay, where do we need to get in 2050? Where do we need to be by 2035? Where do we be that 14% of companies that kind of have those credible targets over the whole time frame? But there's many companies that aren't. And ultimately, it's the company that is asking the investor to stay invested with them through this transition, to believe in that credibility of that transition plan. And I think that's where the transition plan discussion comes in. Actually, the transition plans are in some ways an invention of that TPI ecosystem. So the first time that this question was being asked was actually in the CA100 plus net zero benchmark, where it was called decarbonization strategies. And it was really the question, okay, you have now set the targets. What is your strategy to actually meet those targets? Do you have a credible strategy to do that? And that then got picked up in TCFD and became transition plans. And then we had at COP26, we had Rishi Sunak jump on stage and say, well, in the UK, that's going to be mandatory. And the TPT is basically the effort to try and figure out what that actually means. Again, it's fiendishly complex. There's many different aspects to it, from what are you doing with your capital allocation to things like just transition that Nick and others are working on. And so again, I think it requires the same spirit, the same effort of coming together, bringing together experts from academia, from investors, companies, asset owners, and trying to understand, what are those key features in the transition plan that we really need to see? How can we mold them into data points? How can we go out and collect that data and quality control it and bring it back into the investment process?
Thank you very much for that. So I open to the floor, and we'll go and I'll take some questions around the room. If you want to start from...
Hi, James Long from Egypt Fixed Income. First of all, thank you for all the work that you guys are doing. Your data is absolutely invaluable, and we particularly like the fact that it's analyst driven and not kind of machine learning or other techniques which tend to have less accuracy than we want from some of the third parties that are out there. But my question is really about whether you have ambitions to introduce within your carbon performance metric, whether or not the company is actually decarbonizing. Your carbon performance section, or combined with your management quality, already looks at a lot of the things that will judge whether or not it's credible, like do they have a medium term, short term, long term, all of these elements. But the number one most important thing about whether or not it's credible, a target is credible, and that performance is credible, is they're actually decarbonizing. So I just wanted to get a sense of where is that going to form in your pathway?
I think there are two key data points that can shed light on this. One is just to look at recent trends in the company's emissions. Okay, so we're getting to the point now where we might reasonably have expected to see companies reduce at least their emissions intensity over the last 5 or 10 years. There are trickier questions about how much, given that we're sort of hopefully at an inflection point in history and companies are going to be doing a lot more in the future. But that is certainly one entry point in here. And I think the other entry point is looking at companies' capital spending, because real emissions outcomes should flow from capital spending decisions. The tricky thing about CapEx is that there isn't a one-size-fits-all question that you can, or at least a quantitative question, you can ask companies about CapEx, because what companies need to be investing in is very sector-specific. But also, I think the investor community needs to be careful not to micromanage companies and fall victim to technological determinism by saying that, well, this report says that you need to be investing in that. and therefore we require you to invest X in technology Y. There are some sectors where things are pretty clear. I think for car makers, investment in electric vehicles seems to be a very legitimate thing to focus on. For oil and gas companies, people are rightly focused on how much they're still spending on new reserves, exploring new reserves. But I would see those as being the exceptions rather than the rule in terms of how much of a single rule of thumb you can apply to businesses across sectors or within sectors.
I think it's also worth noting that as TPI moves forward, you're getting that back data. And equally, as we sophisticated that understanding and that analysis, we also move more into an accountability tool of whether they're delivering against those credible paths. And I think that will be an interesting transition from the set the forward looking, is that credible, to are you delivering? And that will in turn inform investor engagement about you are on target, you're not on target, where's this going? And I think pinned also to capital expenditure is going to be increasingly the focus.
Thank you. Mike.
Thanks, Faith. I think the first thing we should do is just acknowledge the debt that Citizen Savers own you and Adam for sort of 7 years ago turning that dream into what we have today. I mean, this juggernaut is now rolling. So I think just firstly acknowledgement what you have led the building of. My question is a bond question. And by the way, I have to say, Faith, that the answer you gave, what is the favourite bit of your job, as an ex-director of Brunel, I think I got a different answer to the one you gave, Adam, about TPI. My question is a bond question, and it may end up being a slight challenge to Simon's last response. The divest engage discussion is dead. It's very old school. We need the continuing withdrawal of financing emissions. I was involved with a bond mandate a little while back where green capex and general capex spending was included, so the investment manager had to take a view on a bond issuer's capex plans and exclude certain companies. We sort of came to TPI, I've been following it for many years, with a sort of equity mindset. But if we go into strategic allocation and in that into bonds, we need to do much more work excluding the bonds of the worst miscreants. So what encouragement can you give us? Maybe it's indicators 6.1, 6.2. What encouragement can you give us about using TPI output in the context of bond mandates?
No, absolutely, Mike. I will. I'll direct this to my colleagues to add some more colour. But I think we have recognised the need to move into that market and to identify and to be able to kind of support that sort of engage your equity, deny your debt type dynamic, which we think is an incredibly
yes. Although the work you've done already is very helpful for that at a first pass.
Yes. No, indeed. Perhaps. So Simon, you talked about kind of the additional the vision about sovereign bonds, and there is already work on corporate. There is coverage of corporate bonds already, although quite limited at this time. But that's the hope.
Yes, no, there is. We assess more than 600 companies now in total. I just talked about energy companies today. Many of those are not only publicly listed companies, but they also issue a lot of corporate debt. So the analysis should also be useful for those companies from a bond perspective. And in addition, we have started to include some of the largest emitters that are not publicly listed. So using our existing methodology.
So I think we just agree. I mean, we've got to go there. We've got to cover that broader market. And you said about the sovereign debt as well. I mean, Adam, you're sort of actively involved in both of these areas. Do you want to add a bit of colour?
Yeah, I mean, I think absolutely you've got to look at bonds. I mean, you've got David Hickey here, formerly of Lothian Pension Fund, now of BlackRock, who was one of the leading exponents of deny your debt rather than so shareholding as a more effective lever on actually determining what companies spend your money on. So
he's having a bit of trouble with Larry on that one, but carry on.
Well, no. He advocated under his Lothian hat. But in terms of, I mean, the Global Engagement Initiative's Climate Action 100, which has been very much a sort of a shareholder engagement, that needs to be in its next iteration as it moves into its second phase, absolutely dealing with companies both as a shareholder and as a bondholder, and looking at those 167 and looking at the debt they're coming back to market with to refinance or to raise, and looking at the kind of assessments that we've got, looking at the duration of the kind of bonds and having some way of connecting duration with the kind of analysis we've got. And I think we need to be getting much more savvy as investors in terms of the way we're engaging both as shareholders and bondholders, not in silos, but in a sort of much more joined up way. And I think the opportunity is through Climate Action 100. And I know we're in that discussion within the investor networks at the moment.
Thank you. I think this gentleman and then across. Oh, I've lost track now of where everybody is. So, and then.
Hi, is this one working? Hi, everybody. Hi, I'm David Bent. I'm the chair of IRIS Foundation, which pioneers the next steps in sustainable finance. I was sort of struck by the tension between the inflection point and the simplicity. So we need industrial revolutions against a deadline across all of our industries, and at the same time you're trying to create a shared language which many of the players across this ecosystem can understand. How do you make sure you don't fix that language too soon and make it brittle to the fast changes that we will need in the future?
Who wants to take that one on? How do we keep this agile? How do we keep it relevant to what our
I'll
needs are?
start. But I mean, I think it goes to the point that all of our understanding of the transition is evolving, and so therefore fixing in on certain concepts and language, I think, is you've got to have some element of understanding that you've got to be willing to sort of evolve as your knowledge changes with that. And I think that's part of the challenge we've got. We started with some of the methodologies in the mining sector. How do you pick up the complexity within what genuine transition looks like in that sector when you've got a mixture of things in your portfolio as a company, some good for the transition, some not so good. And so I just sort of feel we've got to live with an evolution that continues to evolve as our understanding does here.
Yeah, maybe.
And tools have got to be responsive to that rapidly. That's why we've got a centre with the resources to be able to meet that flexibility. Isn't that right?
Better and changed life.
I think, I mean, from a data management perspective, right, and that's where we spend a lot of time, it's obviously a nightmare. Your measurement instrument is evolving, and what we're really looking for is these long time series in data in terms of kind of being able to understand how things are changing over time. At the end of the day, it's like many things in this transition, it needs to be a little bit of both, right? And we've just been through a rather painful exercise with Valentin over there and Ella and Felix and others to update the Climate Action 100 plus benchmark and evolve that methodology. The 2.0 version is just out for consultation. If you don't like it, please make your views heard. If you like it, please do as well. But I think we will, and probably that's not the last iteration. I think we are compared to where this initiative started, our understanding of the transition has become much more sophisticated. Our understanding of how to measure these things has become much more sophisticated. So I don't think we will see kind of just year after year until 2050 kind of these measurements changing. Some of that has become very solidified, but we will have to adapt. And we will have to, new issues are popping up. The just transition is a great example of that. This is something that 5 years ago very few people talked about, and it's now it's becoming an increasingly important issue. And I don't think it will continue to become more important. So we will need to evolve those data tools, and maybe it's one or two indicators today, and in 5 years' time it's 5 or 6. But it's not going to be easy, and I think a big part of the work is around kind of trying to understand how, what is that kind of impactful data point? What is the bit that investors really want to know? And I think that's where it's incredibly helpful for us as data providers, but also I guess for university to have that feedback, right? And get that feedback from the market to say, well, we are in conversations with the company today. We need to understand this bit. Yeah.
I mean, we've obviously changed the indicators over time. Simon, you gave some data as to how the companies had sort of gradually kind of improved in terms of those scores. I would also say that although they'd also improved their scores, our perception of how we rated them, actually, we did tighten quite considerably your ability to score as well, perhaps, on some of those areas. So there was as well as an improvement, there was actually a tightening, I would say, of the criteria around there. I mean, as an asset owner using this data, I'd say I'm sort of trapped between the need to be agile, move forward, recognising the dynamism of this transition. At the same time, I'm held to, please don't keep changing the goalposts. If you've got to set a target, please stick to that target, because I get accused from the beneficiaries of, am I greenwashing because I have changed the parameters of which I set the target on. So it's quite difficult sometimes because you're trying to set targets on things and give people that assurance that you genuinely mean to kind of improve things. But yeah, sometimes you do end up backing yourself into a bit of a corner. So it is a bit of I think, an active tension between consistency and ability to see that time series, which we found, I think, is incredibly important, particularly if we're trying to demonstrate progress, at the same time being agile and aware of the fact that the needs keep evolving. So yeah.
And it's like the 2050 one, though, isn't it? It's like net zero goal 2050. Well, actually, a credible net zero company target is short, medium, long term. It's not just the 2050. Some companies presented their first assessment from TPI as a 2050 aligned goal, as meaning their company had a credible net zero target as assessed by TPI, and that's not the case. They had a target for 2050 that met our criteria, but they did not have a proper transition aligned set of targets, and that clarification is critical.
So I'm going to take this gentleman at the back of the blue shirt, I think, and then
there's a woman there in blue as well.
Next Spencer, and actually, if I can build on that, just talk about the challenges of rebaselining, particularly if you talk about climate budgets. Should we, how are you thinking about being consistent with the past versus consistent with the future?
So do you want to take the rebaselining? Do you want to take 2 or 3 questions all at once? So if we could take a few more, do hands up again in the middle. So we'll take this little bunch in the middle, if we may, take those 3, and then we'll I might do it in blocks because it's absolutely different. I don't know how lecturers do this. So.
Hi, thank you so much. My question is about, we often look at actions that the market or private companies need or are taking to make this transition, but is there a growing or emerging share in the market that is looking to hold governments accountable for their part in climate policy?
Excellent question. Fine, we'll take those 3 and then I'll come and do them in blocks if that's okay.
Thank you for your time. I wanted to find out, so since you mentioned that you work with a lot of corporate, financial and banking sector based companies, there is a lot of emphasis on net zero and decarbonization. However, these companies carry on investing in projects in the oil and gas sector and sectors that are contributing to a bigger share of the carbon into a the atmosphere. So when you are taking, do you take this into account, the TPI, when you are rating these companies or when you are providing data on these companies?
Thank you very much. So I'll take those. So we've got about the baselining. We've got about government accountability. I'm going to give that one to you, Adam. The baselining, Simon. And then banking and the net zero and how do we build in kind of what they're actually doing versus perhaps their plans or the commitments and perhaps adding some colour to the work that we're piloting currently with the IGCC on banking. But so Simon, so first of all with baselining.
Yeah, I mean, I think the answer to that is quite short. So we do rebaseline in the sense that when new scenarios come out, which reflect the fact that the world has turned out differently to what the scenarios originally foresaw, we update our benchmarks accordingly. And clearly what that does could cause some problems, but at the end of the day, I think our judgment is it's most important to stay current and reflect the new reality. So I think that's the short answer to that question.
So you've got a short answer to the government accountability, Adam.
Yeah, I mean, one of the areas of really exciting work, which is a project at the moment led by BT Pension Fund, which the investor networks, PRI, IGCC, etc., are supporting also, is how do we look at sovereign debt? All of us as funds, as has been in the news, how own government debt, and how fun that is. But it's an area of like how when we set a net zero goal as a pension fund, do we actually look at that debt? And at the moment, we're working on developing a methodology that's going to be shortly coming out to consultation on that. And within that methodology, you're going to be looking at does that government have credible targets aligned to their national determined contribution? Is there legislation? Are they still providing subsidies to oil and gas, etc.? So I think it's got some really interesting dynamics, and that in turn, like TPI as a tool, has empowered engagement and decision making with investors, with companies. I think this tool, when it comes online, will really present a different way for us to have a dialogue with governments around the kind of transition finance they're going to need to support their transition objectives. But also the work of the investor networks is critical in this space, where we can sort of have that investor voice to government that we need to see aligned public policy to enable the transition, because we're all interconnected. Our goals as a pension fund are dependent on government meeting its goals, on companies meeting theirs. Otherwise, quite frankly, we're going to end up just washing out our assets, putting it all in cash, and saying, oh, look, we're net zero, but actually nothing's changed in the world. And so therefore, you've got to have that policy piece, so absolutely critical.
And banks being another critical
And
component.
banks and the role of banks in that. I think, I'm not supposed to say it, but I think the banking methodology being developed with IRGCC is an accountability lens, and all those big banks in GFANs. I think there's a real opportunity to sort of focus in on the important critical role that they've got. We're also shareholders in many of those banks, and I think that will enable a very different dialogue with a lot of these very important institutions, and the role of financing companies that they have, and the important role that they're going to have in financing the alternative path that we need them to go upon.
And Simon, anything else to add on that banking work, particularly?
No, not really. I mean, you know, we've started to assess banks, and I think really the one word answer to your question is transition, right? So in the world as of right now, we still have lots of fossil fuel production, and banks play an important role in lending to fossil fuel producers. And we need to go through a process of weaning the world off fossil fuels, which means banks stopping financing them, but we can't do that overnight. Hence the word transition.
I'm going to take two more questions from that block, and then what I can say is there will be drinks afterwards. Do come and grab any of the panel here in terms of asking them a question, or indeed any of the other team for TPI. So sorry we couldn't get through to everybody's questions, but if I could take these two questions together, and we'll
I'm a student here at the NSC, and I have a question about your results and assessment that is mostly for Professor Dietz. I was wondering whether you might feel that the indicator of management and the carbon performance one might show slightly different pictures, as in the primary one showed that pros are, especially in the energy sector, doing much better than the carbon one shows. And I was wondering whether you have an idea of where that comes from. I mean, is it easier to perform or outperform in the former one than the latter one? Which one should we be looking at?
excellent question, and the gentleman in the polo.
Glenn Anderson from Fidelity International. First and foremost, thank you very much for all the great work that TPI has been doing over the recent years, and also thank you for the continued work on the climate ambition upcoming with the launch of the Transition Center. I wanted to ask about sovereigns, coming back to some of the points that you had mentioned on the table, and particularly what are different barriers and enablers that you see for an assessment of sovereigns that is consistent with the principles of TPI. I guess unlike corporates, they do pose quite a different problem set, different zones of control, different points of data that need to be analyzed. Do you see that this is a field that is ready to be taken on a robust analysis like this, or do you see that there are more, let's say, foundational elements that need to come into play in this?
Thank you for that. So we'll start off with the carbon performance, management quality. Are they aligned? Is there?
Yeah, so I mean, we've always seen these things as complementary. So I think we've always been clear that you have to look at both to get a picture on a company. You can't just take one. As it happens, they're not often not very well correlated. And really, there's quite a complex set of reasons for that. They correlate more if you look at historical management quality versus current and future carbon performance. The idea there being that current or historical management steps are a precursor to then reducing your emissions in the future. Otherwise, there can be a variety of reasons at play, including a company's positioning in a particular sector. So if you're an electricity utility with a fleet of wind turbines, you're going to be, you're going to be aligned. Right? Or if you're a steel maker that happens to make steel through recycling scrap, you're naturally well positioned for the transition compared with a traditional steel maker. So these are some of the things that contribute to this less than perfect correlation.
I think as a user of the data, I think obviously you're attracted to carbon performance being kind of when the rubber hits the road. I mean, that is the indicator as to where we're going, that forward-looking metric that really brings something new as a user. That said, I mean, talking to some companies about carbon performance, they're not there. So, you know, we need the management quality sometimes for those at this lower end of the steps. So they are both equally important. If you don't have that governance in place, you're not going to get the carbon performance. So there is that sort of interdependency between them, and we do use both of them very lively. Although obviously the what Simon was saying about needing to introduce more sectors to carbon performance is absolutely needed. As asset owners, we need more and more carbon performance data across a wider set of companies, but both are useful in different ways. Adam, I'll go to you and just perhaps to very briefly touch on the sovereign's work and to address the gentleman's questions.
Just on the last one, the anomaly is Tesla, where you've got perfect alignment on performance and terrible on management quality, and I don't know why that is. But it's sort of, and they were quite annoyed with us for sort of highlighting it, but they don't disclose on the management. And it's not insignificant stuff in the management quality in terms of what are the emissions with the production of your fleet, etc. I mean, some of these things are equally requiring attention. So maybe not equally, but anyway, in terms of sovereigns, actually Antonina at the front here is leading the work on that and has developed the methodologies with the team. And Antonina, can you put your hand up, because you can probably give a more informed answer if you talk to Antonina after the event. But I mean, absolutely, I mean, we as a pension fund, as with a number of the funds in the audience, hold government bonds. We need to have a way in which to understand the risks and opportunities within that part of our portfolio. We are developing a methodology and a tool that will be able to provide us with a way of doing that credibly. There'll be principles that we've been discussing amongst the investor group that's leading this process with the support of TPI around ensuring that it's publicly disclosed information, drawing upon the work of LSE in terms of legislation frameworks. But equally, what is their need in the transition? And I think this is where the conversation could be really different. And this is the bit I'm particularly excited. And I go back to that South Africa example. Understanding South Africa's transition plan that it has set and it has detailed ahead of the last COP in Glasgow presents an opportunity to really work with the government, understand how they're going to deliver on their national commitment. What does that mean in terms of the energy system transition? What does that mean in terms of the finance that they need? And how can we provide it? And a tool like this that we're developing here, I think will be absolutely instrumental in enabling confidence amongst investors to be able to roll in behind a credible plan like that. And in turn, give more countries the sort of confidence to go down that path, knowing that finance is wanting to find ways to gain that independent confidence that the countries are sort of putting plans together. And I think for us, that kind of tool is going to be really important. So there will be a consultation, there will be a methodology out for comment on. So do engage with that.
So thank you. I mean, I think what I'm taking away both from Simon's presentation and this panel is we're talking about an incredibly complex topic. We recognise the need for more nuance as we go forward, and we need to continue to innovate. And I think I'm taking all of that away from those discussions. And I think what we've got with the centre, we've got the data provider, we've got the academic, we've got the North Star of meeting those asset owner needs. And I think it's that power of that combination, that collaboration, that will enable the Global Climate Transition Centre to go from strength to strength and really enable us to achieve our mission and vision in this area. So thank you all very much for your time today, and thank you for coming.